So, yet another rate freeze from the U.S. Central Bank. Let's talk more about what's behind the latest decision with Professor Greg Buchak. Welcome.
Hi, thanks for having me.
Thanks for joining us. So, Professor Buchak, what are they waiting for? Why another rate freeze?
Sure. Well, the Fed's objective here is to balance inflation against full employment. And throughout this cycle, the labor market has remained incredibly strong. Inflation has also remained stubbornly high. So this is sort of what led the Fed to raise rates and keep them high in the first place. This morning, U.S. time, we had a very encouraging inflation report with core CPI inflation number showing a monthly increase of about 2% annualized. So from last month to this month, it was 2%. That's exactly actually the Fed's target. So that's really good news. The markets kind of celebrated this as a green light for the Fed to start rate cuts in the future. But given that inflation is just touching the Fed's target and unemployment remains low, the Fed didn't have a strong reason to cut today. Instead, the debate is more around when the Fed will start cutting and how quickly they'll cut.
Right. And when asked what will help inflation reach the Fed's target of, 2%, the ultimate goal, Powell said slower inflation will come from where it's been coming from. Now, what does that mean?
Yeah, so Powell said this in the context of sort of trying to understand what's been causing inflation to slow down and what will continue to slow it down in the future. Further on in that quote, he sort of points to the unwinding of pandemic-related distortions, both in terms of supply and demand. Okay, so the big drivers of lower inflation have been reduced costs of goods and energy. These prices spiked during the pandemic because supply was disrupted. There was a lot of trouble with the supply chains, while at the same time the government engaged in a lot of stimulus that just put more money in people's pockets. And so when there's more money chasing fewer goods, that causes prices to increase. What Powell meant is that he expects the reversal of these trends to continue in the future. And then sort of when looking at what's contributed to lower inflation, almost all major categories have been trending down, with the exception of shelter, actually. So housing and rental costs, these are still elevated. And what's kind of interesting here is that these prices tend to move much slower. So I would expect actually prices here to move down in the future as well.
So it looks like we're going to see rate cuts, not 3, not 2, but just 1 only. Professor Buchak, what's your take on this?
Yeah, so as I mentioned, today we had a really encouraging inflation report. And in the time between that report and the Fed's statement, markets were sort of nearly certain there would actually be 2 rate cuts this year. So the Fed sort of surprised markets by projecting only 1 rate cut. And in fact, actually, some people at the Fed still expect no rate cuts this year. So I think there's really 2 reasons the Fed disagreed with the market consensus going into this. First is on the labor market side, which is sort of the other half of the Fed's objective. Last week, we had a really strong jobs report with almost 300,000 new jobs. The unemployment rate was coming in at 4%, which is very low. And this strong labor market means there's no really rush on the Fed's part to start cutting rates. And then second, and this is as Chairman Powell said, today's inflation report was just 1 data point. It's true there's been a lot of data kind of pointing towards inflation cooling. This was actually the first report that really showed the Fed hitting its target. And given that this is just 1 data point, I think there's still some uncertainty, and it makes sense for the Fed to sort of err on the side of making sure inflation is consistently at their target rather than risk reinflation from rate cuts. So when you sort of put this all together, there's some uncertainty on the inflation side, and given the strong labor market, the Fed really has space to take things slow.
Professor Buchak, you briefly mentioned this. We have to talk about the timing of an upcoming rate cut. Now, a lot of market analysts are predicting 1 rate cut will come before the presidential election in November. Now, why before the election?
Sure. So there are 2 meetings before the election, one in July, one in September. If economic trends continue, I think there's a decent chance the Fed will cut in at least one of these meetings, probably more likely in September. So my view on this is the decision is going to be based on economic factors like we've discussed, trading off inflation versus unemployment. It's not going to be a political decision. People often sort of have this idea that the Fed will be political when it suits those people's narrative. So in this case, a rate cut before the election, it would stimulate the economy, it would make people feel more optimistic, and this would benefit President Biden. So if the Fed does cut shortly before the election, I think you'll likely see some Trump supporters sort of accusing the Fed of being political. And likewise, if they don't cut, I think some Biden supporters may say the same thing. The truth is the Fed actually has a really strong track record of being apolitical. They care a lot about being apolitical. And so whatever the decision the Fed makes, it's going to be based off of economics and not politics.
Before I let you go, Professor Buchak, briefly, does that mean the Bank of Korea will not slash its interest rate until this fall when the U.S. Fed is expected to?
Yeah, I think a lot of countries tend to follow the Fed's cue on monetary policy because an asynchronous rate cut sort of puts a lot of pressure on foreign exchange markets. At the same time, the rate of inflation in Korea is still a bit above the long-term target. So sort of based on these two things, I think there's no big rush to cut. Given that the U.S. cut is probably only a few months off, I think Korea can wait until that happens.
All right, Professor Buchak, thank you so much for joining us this morning. You enjoy your evening there.
Thanks for having me.